Morning, guys. The claims numbers came out. It was 213,000, which is lower than the expected 220. Continuing claims, 1,737,000, which is a little bit higher than the expected. It was revised lower last month, though. The one I think is the most important one is the Philly Fed business outlook. Came in at 17. We were expecting 9.5. And that one kind of had a troubling trend lately where it's been going lower. So this is pretty nice. The one thing I think the market should probably like, and the S&P ticked up, they were down 10, now they're down about 7. The one thing the market should like is that we've convinced ourselves out here that the Fed's too worried about the China trade talks. The Fed's a little worried about the government shutdown. And these kind of A- numbers improving are good for the market, but not good enough to have the Fed rethink their current position. Now, the stock market is right above that 2,600 level, the S&P 500. I know you guys sometimes think that technicals are voodoo, but if everybody's looking at that same number, it becomes very important. So my guess is we start to build a base above it now. These numbers are helping that out a little bit. Back to you, Joe.
All right, yeah. I don't think it's voodoo. We try to use everything we can since nothing works. So anyway.
Okay, good.
Thanks, Jim. Steve Liesman.
Amen. Thanks.
Yeah, Steve Liesman joins us now.
Yeah, nothing works, right? Yeah, I'm trying to look at the federal workers. I don't have that in front of me, but there's a separate track that tracks the claims by federal workers for jobless claims. It doesn't show up. What's interesting, though, is you're not getting a big pop in claims that you might get from private contractors who would file through the regular thing, and there may be some delay in there, or maybe they're just not doing it. The Philly Fed is a good number coming up. I want to just take a very quick look, and since we're not getting key economic data, look at some of the alternative data that's out there. And the first thing I want to look at are these Fed manufacturing surveys, which have really, when you put them together, it's a scary look. I saw the Dallas and Kansas City ones. I'm like, okay, those are kind of oil-based. That's okay. I kind of get why that would come down. And in fact, the last lowest number there is back in September 2016 with these numbers, Becky, when oil was last at low. So I'm like, okay, that's fine.
Makes sense.
But then I don't quite get Empire State and Richmond, both of which have slowed pretty sharply. And we'll see.
Richmond could be federal.
No, it's a manufacturing index.
But is that anything tied to contractors, government contractors or anything?
It's too early. That's a December number. If it was a January number, I'd kind of get that. I still wouldn't get it. Anyway, it's worrisome. I like the idea that maybe Philly snapped back in December. And one more alternative piece of data here, which is we counted up the use of the word slow, slowing, slower in the beige book. And that's up 51%.
Wow. Well, you know what? That's the type of homework that Jim Cramer was talking about.
Right.
You hear directly from the companies that are saying these things.
But that's, of course, in a Fed report, right? So it's up 65 from 43, and you can see it kind of crept up there month after month after month. Again, don't know if it's long-term or if there's just some kind of slowing, or maybe the cumulative concern out there among business of all the things, all the balls that are in the air for businesses are things that finally said, all right, wait a second, things are slowing down now.